it's not like with the savings and loan. It's hey, you can make the payments. You've been, they'll check the rent if they paid rent for 3 years or whatever. They're seasoned people. They could do it. Hey everybody, welcome back. Guess what? It's round 3, JoeyB and Jeff Badu over here. This is addressed to real estate in general. And real estate is comprised of, people that own property, that want to sell it sometimes, and people that want to buy property. What we're going to experience and what we're experiencing right now, and Jeff, I'd like you to address is the underwriting process. And underwriting means how are you going to qualify for a loan? It's going to be devastating if you have to go to one of the big banks or you got to go to the local savings and loan. That ain't going to work. The underwriting is going to be bad. Why? People are losing jobs, some people can't pay rent, this and that. But here, Jeff, I want you to address this. Seller financing.
Yes, sir.
And I know you've done some deals with seller financing, but, especially like if you're a real estate broker right now, if you don't understand seller financing, you're knocking out 9 out of 10 people that could buy. But what's the most, Jeff, what's seller financing? With the underwriting process changes so that all the requirements and all the boxes that you got to check off.
Exactly.
It basically, what does it get down to? Whether you have a job, a work history, whether you, your wife have a job, a work history, and then tell us about seller financing.
Yeah, so seller financing, I would say, is basically the way the transaction works is you have a buyer and you have a seller. Instead of a lender, a loan company, a bank, giving the money giving the money to the seller himself becomes the lender, right?
The seller's the bank.
Exactly. The seller is the bank. So it's a transaction between two parties. I mean, you can still have a real estate agent. You, of course, have to have an attorney and all that. But the seller is giving the money to, or not physically giving the money, but they're basically taking the mortgage. They're taking a mortgage upon themselves for the buyer. In exchange, there's a down payment usually that's required. I've seen something as low as 10%. With these deals, you probably do have to have a significant down payment just because it's much riskier. Because the underwriting requirements are so slim. And of course, any seller or any lender can tighten up the restrictions as much as they want. But when I did my seller financing deal, the only thing the seller asked for was show me a personal financial statement. And he takes it off face value. He didn't ask for W-2s, tax returns, and, all the mumbo jumbo that they asked for. Basically, as long as you can demonstrate that you can pay off or you can pay for the loan.
You can make the payments.
Yeah, exactly. As long as you can demonstrate you can make the payments, they'll send you a one-page sheet, fill out your income and expenses, fill out your assets and your liabilities. We'll take it upon face value. They can, of course, verify as much as they want. But if you're a seller, the reason why this buyer's coming to you in the first place is probably because they couldn't get the loan at the bank.
Right.
So you should understand that you can't have as strict requirements as the banks do. Your requirements need to be 10 times less strict. So as long as you can show personal financial statements, they'll maybe run your credit or they'll take it off face value. You can say, hey, I have a 600, qualify me. The main thing they worry about is they want to see your cash flow.
Okay.
Income minus expenses.
All right, we're talking here. Now, what was this? An apartment building or what?
This was a single family in Dalton, Illinois. So it wasn't anything major, but this is usually for apartment buildings.
Okay, but this was an investment because you don't live in Dalton.
Exactly.
Okay. All right. I want you to address two things. One is if you want for people out there that are renting right now and they want to buy their first thing. What would the seller look for? They would be looking for work history, right?
Correct.
That they're making money.
Yep.
And then the underwriting would be such that it's not like
Yeah.
with the savings and loan. It's hey, you can make the payments. You've been, they'll check their rent if they paid rent for 3 years
Exactly.
or whatever. They're seasoned people. They could do it. So tell me the value. What you talked about was the investment end of it.
Exactly.
What if you want to live there? What if you got a family? What if you got a wife and she works and you got a couple kids? This could be to your advantage right now, right? This could be better than waiting for the savings. And tell us about that if you.
Yeah, I mean, basically, if you're looking for a place to buy and you've gone to the banks have turned you down. They said, hey, you're self-employed, you don't meet the history requirement, you don't meet the credit score, you don't have enough documents, so on and so forth. This can be a way for a homeowner to get into their first home or their second home. And generally they can be a good person. They can be somebody who can actually pay the mortgage,
right,
and pay the rent and all that good stuff. So the benefit here is you're creating more buyers.
Okay.
Like those buyers that are basically put to the ground by JP Morgans and the Morgan Stanleys or whoever. Now those buyers can come to the table. It's a huge market of those folks right now. And basically it creates an opportunity for them to live in their home of their dreams as long as they can demonstrate that they meet everything. So for one, you get more buyers. That's the first thing. You open up to more buyers. And then two, it is also more of a personable relationship because you're working directly with the seller.
Right.
That's another benefit. And yeah, I mean, from a personal standpoint, ultimately the goal is you'll get a place to live.
Yep.
Right. So the buyer gets a place to live. The seller can actually sell their home.
Right.
And not have to worry about them paying mortgage payments and this one too, I think we're going to bring up this point. It only works if it's free and clear.
Right. All right. That was the next question. If they have due on sale clauses, the seller. Okay.
Exactly.
All right. So, all right. Let's assume that it's free and clear.
Mm-hmm.
Okay. That's the safest position. This and that.
Exactly.
What are the benefits that the seller gets for doing this?
I mean, ultimately, the seller's able to sell quicker, right? Or they're actually able to sell instead of waiting on that 680 plus. Six-figure family that's coming in. There's not too many of those, especially right now. A lot of people are getting laid off. What if you're in an underwriting right now and you literally lose your job? I mean, you're basically done.
Yeah. From
a big bank standpoint.
Yeah.
But maybe from a seller finance, as long as you can demonstrate, hey, I can find a new job, I'm in a good career. It's just the requirements are so little, right, that you can easily get the buyer that you want. Maybe not the most ideal buyer, but you can get a good buyer. So the benefit to the seller is I'm going to sell my home, first of all. Two, and that if anything, there might be less closing costs and things of that nature too. Three, you're building a close relationship with the buyer because you're working directly with the buyer. To me, the biggest one is you're selling your home. You're getting your mortgage payments and you get a bigger down payment usually. So these types of loans do require big down payments. So you're getting a lot of money up front, and then you could possibly sell the loan on the secondary market to another institution. So now you take the risk off your plate. They send you the money, and then you.
What do you got to do? What's a seasoned loan? One payment, couple payments that they've already made.
Yeah, I mean perhaps maybe one or two. Banks are getting more tight nowadays, so maybe three, perhaps 3 payments. As long as there's 3 on-time payments, you can demonstrate it. I know when I was doing my loan, when I bought my condo, I think they sold it like before the first payment was even made.
Right.
So.
Okay. Well, here, I'm addressing this to both buyers and sellers. Mm-hmm. But as a buyer, what do you want as a buyer? You want the lowest interest rate possible. You want the longest term possible. There's got to be no prepayment penalty.
Exactly.
And you probably don't want a balloon payment.
Yeah.
But if you're a seller, it's just the opposite, right?
Exactly.
Yeah. All right. So if you're a seller, all right, I'm the buyer. I want to buy your house.
Exactly.
You own it free and clear. I want to get it at 3% interest because that's what I see on a guaranteed rate. You could get 3%. I want 3%. I want a 30-year loan, and you got to sit with me for the whole 30 years. Okay. You're not happy about that. What do you want? You're the seller.
I mean, if I'm the seller, I want a higher interest because I'm taking on more risk by giving money directly or giving such a responsibility to a buyer, right? I'm not even collecting the 100% of my cash like I would have had I worked through like a normal bank. So if I'm a seller, I want high interest.
Yeah.
Right. I want prepayment. I want a 5-year balloon.
5-year balloon.
Typical. And I don't want to be locked in for 30 years. I mean, it's going to be amortized over 30 years, but I just want a 30-year amortization loan with a 5-year balloon. Basically.
Okay, so what is a 5-year balloon? What happens? What are my alternatives in 5 years?
Yeah, so basically a 5-year balloon is where all the principal of the loan is going to be due at the end of year 5, basically. So in year 5, the entire loan principal is due. So you're still making monthly mortgage payments based off the amortization schedule, but the principal itself becomes due in year 5. What you can do at that time, as a seller, you can basically refinance the loan and say, hey, buyer, you've been paying on time and everything, I'll give you another 5 years.
Okay, so
Right.
you're going to rewrite the loan with me.
Exactly.
Okay.
Exactly. So that's one benefit. You keep that relationship. You're keeping your payments, right? You're still collecting money. You're collecting a lot of interest over time. If you're talking a 10% interest rate on, let's say, a $200,000 principal, that's a lot of money.
Yeah.
That's $20,000 or so per year.
And you as seller, if
Right.
I cash you out, what are you going to do with your money? Invest it at 0.1%, put it in the bank?
Not at all.
Okay.
I'm probably going to buy another piece of real estate,
Okay.
to be honest.
Okay.
So yeah, as a seller, what I can do at the end of year 5 is I can refinance a loan. I can, if you don't pay the full principal, I can go ahead and foreclose on you because the loan is due, or I can maybe sell that loan to another bank who's willing to.
Or I mean, you sell to individuals.
Right, you can sell it to an individual. You can sell
yeah.
it to anybody, pretty
Yeah,
much.
we got a guy on our Renatus team. His name's Jeff Armstrong. That's where I got a lot of my. I was surprised there was a secondary market. You could sell it on the market.
Yep.
You know, so maybe you got a loan for $100,000 at 8% interest, and the market is you got to get it for 10. So what? He could sell it probably for 80, right? Or,
Yeah,
something.
exactly.
You discount the loan, and he could get his cash, which might be actually better for him than trying to sell it for $20,000 less.
Yeah, exactly. Overall, you win. It's a win-win. And even from a tax standpoint, too, not to get in too deep, but it's an installment loan or an installment sale. So basically, you don't even have to pay the taxes up front on that sale because it's structured as an installment.
So wait a minute. So you as the seller, beside, you're not going to get all the cash,
Exactly.
but you're saving money on taxes. And
Yeah.
explain that. Just explain that.
Yeah, so basically, instead of let's say you sold a home for $100,000, right? Instead of you paying taxes on the full, let's say the profit was $50,000.
Okay.
Right? Instead of paying taxes on $50,000, you can now break it up, maybe $10,000 this year, $10,000, basically a 5-year installment loan.
Okay.
So instead of paying the full, like getting you into a new tax bracket, a higher tax bracket, now you're in a lower tax bracket, and you're only paying taxes on the $10,000 for 5 years.
Fantastic. So listen, in every adversity, there's a seed to an equal to or greater opportunity. This may be the chance for people that a month ago couldn't qualify for a loan for a house they want.
Exactly.
Okay? If they still got jobs, or they still will get jobs, or whatever, you got to play the game. And playing the game is you got to have knowledge. You got to know how to implement. He can guide you through those type of things. So,
Absolutely.
hey, if you like this, stay tuned. Jeff, thank you very much.
Absolutely, Joe.
And, we're going to have Jeff's information. Feel free to call him. And I got to say this. If you like this, please please share, and subscribe. All right, thank you very much.
Thank you, Joe.
Hey, my friends, if you enjoyed this video, like it, share it, and subscribe it, because we've got a lot more great things coming.